taxation issues are quite important in relation to any overseas operations, and therefore some of the issues that you probably need to consider are set out in this slide. So what I'll do is I'll go through some of them, cover them in some detail without giving any complexities. The first thing that you need to consider when you're looking to go abroad is whether or not the presence overseas is going to be in the form of a temporary presence, or you're looking to expand yourself on a more permanent basis. Now, if you're looking at to be on a more permanent basis, then you're looking to consider setting up a subsidiary. If you're looking at it on a temporary basis because you do not know whether or not your products are going to be successful, then our recommendation is that you set up your operations either in the form of a representative office. A representative office does not mean taxable presence in the overseas country. It just means that you are testing the market, providing samples, just generating an interest in your products before you're able to decide whether or not to have a more permanent presence. To the extent that you go for a more permanent presence, then on most taxable jurisdictions, you are going to be having a taxable liability, but the taxable liability will depend on whether or not you have a branch or a company. A company generally is taxable on its worldwide operations, irrespective of where you're located. So if you were to go and set up a subsidiary in China, then the Chinese company is going to be taxable on its worldwide profits rather than just the profits arising in China. There are a few exceptions to that, and there are some countries that work on a territorial basis. Countries like Singapore and Hong Kong only tax you on the profits that you generate in that jurisdiction. So the interim measure between a representative office and a subsidiary is that of a branch, a permanent establishment. In this case, the profits attributable to that branch will be subject to tax in that jurisdiction. So having decided what form of entity, whether of temporary or a permanent presence, you're going to establish in the overseas country, the next thing to consider is how you're going to fund that entity. Now, if you're looking at a temporary or a branch arrangement, then in most cases what you will do is be to provide interim finance by way of an intercompany loan or short-term loans to fund the provision of staff, the establishment costs, and other related expenses that you will incur in the overseas territory. In most cases, debt finance is more tax efficient than equity finance. And the reason for that is that an interest deduction will qualify for a tax deduction, whereas a dividend is not deductible for tax purposes. So we encourage our clients to consider debt finance, but there are restrictions on the amount of debt finance that you might have. Every country will have a restriction on the amount of capitalization you'll have in your overseas country. And these are called the thin capitalization rules. And it basically seeks to ensure that an equal amount of debt and equity is injected into the overseas entity. So what will happen is that if you work on the basis of a 50-50 debt to equity ratio, in most cases that will be acceptable in the overseas countries. There are some countries that extend that ratio to 5:1. So if you were to go to a place like Luxembourg, you could have a debt to equity ratio of 5 times debt over your equity. But just working on the standard principle of 1:1 is acceptable in most jurisdictions, and therefore 50% of the financing will qualify for relief, and 50% will be in the form of equity and no relief for it. Now the next thing to consider is that if there is a loan from the parent company in the UK to the subsidiary in the overseas territory, any payment of interest may attract a withholding tax. So you now need to consider what is the route for the financing. A direct provision of a loan will mean that you will have to look at the double taxation treaty between the two countries to see whether or not a withholding tax is payable. The benefit of double taxation treaties is that it seeks to eliminate or mitigate some of the withholding taxes that you might have. So for example, a Chinese company paying interest to a UK company, the standard rate of withholding tax is 25% on an interest payment, but the double taxation treaty reduces that to 10%. In some cases, it's reduced to 7%, depending on the nature of the entity that you establish. So funding is quite important, and cash flow becomes important. And so you do not want to have a part of your cash stuck in withholding taxes. Now, if you have suffered withholding taxes overseas, then the only way you're going to get relief for it is by way of a credit against the UK taxes payable on your profits. If the UK company is making losses, then any withholding taxes that you have suffered overseas becomes a cost, because you will not be able to credit it against the UK tax payable. And the best you could do is possibly to expense that overseas tax. But again, the level of relief that you're getting on it is not the same as having a full credit. So the best thing to do is to see whether or not you can go through intermediate companies. In some cases, you can set up an intermediate company to provide the financing. Now, the reason for that is that you may have the benefit of a more extensive treaty network, or the rate of withholding tax is limited to nil, depending on the type of structure. Now, a typical intermediate financing company would be a Dutch company. And the reason for that is any payments by a Dutch company to any persons outside Netherlands does not attract any withholding tax. So if you were looking at company in one of the tax havens, even the UK would impose withholding taxes on it. So if we were to use a Dutch company to channel the interest payments, then the withholding taxes are completely eliminated. So it's quite important to look at double taxation treaties for the purposes of your structuring. The next thing is, having generated profits in the overseas entity, is what is the best way of getting the money back. Now, if you decide that you have an overseas company, you pay tax in the overseas location on the profits you generate, and let's assume that the tax rate in the overseas entity is at the rate of 30%. You then have 70 left over, profit after tax, and the question is, do you then repatriate those funds in the form of a dividend? If you pay a dividend from that jurisdiction, in most cases you will have to look at the withholding taxes on the dividend that gets paid. Many countries impose a distribution tax, and in most cases these are credible against your UK taxes payable. However, the UK tax regime has been reformed, and to the extent that you derive your dividends from an overseas entity, those dividends will not be subject to tax. In the case of a small company, you will need to ensure that the double taxation treaty has a non-discrimination article. And a non-discrimination article means that any entity has to be treated on a fair basis, irrespective of the jurisdiction that you belong to. So if you have a territory that imposes a withholding tax, and an example of that is India, it's not called a withholding tax, it's called a distribution tax. The problem with that is that if you're going to be exempt on the dividend received in the UK, that distribution tax that you pay in India will not be credible against your UK taxes, and therefore is an actual cost to you. So rather than have a dividend distribution out of such territories, you may wish to consider alternative ways of extracting your profits. In many cases, the best way of doing that is by imposing management charges. And if you are providing IP or technical services, it is justifiable to make a charge for the provision of these services. Whether you have technical services, management charges, many countries will also impose a withholding tax on such services. However, the good thing is that the payment for technical services and management services can be reduced to nil under a double taxation treaty, but in some cases it will be limited to a figure of about 10%. For example, India will impose a withholding tax on 10% on technical services. Now, when you start making charges from one company to another company, you're likely to come across a concept called transfer pricing. Transfer pricing is a mechanism whereby tax jurisdictions make sure that multinational enterprises charge an arm's length price for the related party transaction. And why would they want to do that? They just want to make sure that any activities performed in any one country is subject to tax And the profits are determined on a fair price rather than manipulated. And therefore what will happen is that the OECD has come up with a framework as to how you go about the methodology in order to determine a fair price for the services that you provide. And you are therefore expected to have some documentation in order to justify your prices. Now, if you're a small company, you might benefit from a small company exemption for transfer pricing. But many non-UK jurisdictions do not have such exemptions, and therefore you are required to have documentations to justify your transfer prices. And in the event that you do not have the relevant documentation, it is possible that you might be subject to some penalties. So what is quite important is that when you decide to go in an overseas territory, it is to find out what are the local requirements, not only in relation to the filings for the company, but also in relation to any employees that you might have. So you will have to be registered for payroll taxes. You might have the equivalent of VAT, which means you have to be registered for VAT. And in addition to that, you'll have the filing of the company or the business establishment that you to have in that jurisdiction. Now, if you have employees in a particular jurisdiction, you will have, in addition to the payroll taxes, you may have social security contributions. Many overseas countries have a very high rate of social security contributions, and it's often worthwhile considering the tax planning opportunities to see whether or not you could mitigate some of that. For example, if you are to second somebody for a period of no more than 5 years within the EU, it is possible to defer any social security payable in the other jurisdiction. And if you look at some of the EU territories, the rates of social security contributions are fairly significant. It's always worthwhile looking at some of the incentives that are available. In addition to social security contributions, you may wish to incentivize your overseas workforces in the form of share options or other incentives. In most cases, any provision of incentives in the form of share options will be regarded as taxable remuneration. So not only will the individual be subject to tax in relation to those options, but the company may be required to pay tax by reference to the market value of those options at that point. The question is, will the options trigger a tax charge at the time of grant or when they are exercised? And again, it has to be dependent on whether or not the share scheme is approved by the local jurisdiction or whether it's an unapproved scheme. In most cases, unapproved schemes are subject to a tax charge immediately, whereas proper planning may lead to a deferral of the tax charge until the share options are granted. One of the things that we often do for some of the overseas territories is to encourage them to give restricted shares, and that means that the market value of the share is reduced at the time that they are granted or exercised. And the benefit of that is that you have incentivized your workforce. The income tax payable on that option is relatively low. And what you're trying to convert is, rather than pay income tax, you pay capital gains tax on the disposal of those shares. And this is done because most jurisdictions have a reduced rate of tax liability for capital gains over income tax. Moving on, you need to understand other aspects of the tax jurisdictions in terms of any anti-avoidance provisions. The typical anti-avoidance provisions that you will encounter are the transfer pricing regime, the thin capitalization rules in relation to the debt financing of the entity, and what we call the controlled foreign company legislation. It's probably unlikely when you set up an overseas territory that you're going to fall foul of the controlled foreign company rules. But it may be relevant from a UK perspective. And the reason for that is if you decide to set up your subsidiary in a tax haven, for example, you were to set up your subsidiary in Bermuda to undertake your international activities, then because the tax rate in Bermuda is nil, you're likely to fall within the UK controlled foreign company rules. And the effect of those rules is that those profits that you have been generating in Bermuda will be attributed back to the UK company and subject to tax in the UK. However, under the CFC rules, there are certain exemptions that are available. So it's often important to ensure that you see whether or not your entity can benefit from those exemptions. Most of those exemptions apply to genuine trading activities which are conducted, and so long as you fall within some of the exempt territory rules, then you do not fall foul of the CFC rules. But again, CFC becomes an important issue on the structuring, more from a UK perspective rather than from an overseas perspective. Now, what are the ways of mitigating your tax rates? Now, the UK is considered to be a tax haven if you compare the UK to many of the jurisdictions. Most OECD countries have a rate of tax which is higher than that of the UK. If you look at the US, the federal rate of tax is 35%, but if you add the state and local taxes, your effective rate of tax on your profits will be in excess of 40%. In addition to that, you will have something which is called the branch profit tax that is imposed by the US. Now, in the absence of double taxation treaties, the effective rate of tax on your overseas profits in the US will be in excess of 60%. So it's very important that you look at the double taxation treaties and other ways of mitigating the tax. One of the first things that we would do is to see whether or not you should structure directly the UK to set up a subsidiary overseas, or whether or not you would set up an intermediate company overseas. Territories like Luxembourg or Netherlands are often cited for those sort of structures. And the benefit of that is to see whether or not you can get some exemptions. Fortunately, the UK has an extensive range of double taxation treaties, so sometimes we tend to structure directly. And the reason for that is, one, we want to get the benefit of the foreign dividends exemption, because those dividends will not be subject to tax in the UK. And the second one is, in the future, if you're looking to sell the shares in the overseas subsidiary, we would like to take advantage of the substantial shareholding exemption. And the benefit of this exemption is that so long as you are a qualifying company, on the disposal of the shares in the overseas subsidiary, the capital gains that are derived on that disposal are exempt from UK taxes. Now, to qualify for the substantial shareholding exemption, you need to be a member of a trading group. If you're looking to set up a company that's engaged in investment activities, then you need to look at an alternative structure. You will not be able to get the benefit of the substantial shareholding exemption, and any gains derived on that investment will then be subject to UK tax. So, if you are a trading group, then a direct UK investment is encouraged. If you're a non-trading group, you're often recommended to have an intermediate company outside the UK to hold the investment. And that intermediate company should have the benefit of a participation exemption. And a participation exemption is basically a European territory which exempts gains derived from any subsidiaries, whether they're trading or non-trading. Moving on, in relation to accounting works, in addition to the filing requirements, you may be required to provide details of the UK entity. If you set up a subsidiary in the US, then often when you file your US tax return, you may have to give information about the UK entity. And the reason for that is to see whether or not you've complied with your transfer pricing requirements, whether or not you have provided incentives to your employees, in which case you have to register and account for the taxes payable on those overseas employees. In addition to that, you may have to produce a tax return on a consolidated basis. Now, it's sometimes possible that you cannot do it on a consolidated basis. The reason why we wish to have it on a consolidated basis is that you may have one subsidiary that makes profits, another subsidiary that makes losses. And if they're in the same territory, we would like to have the benefit of a group arrangement so that the profits and the losses can be offset against each other, and the net amount of profit is then subject to tax in that location. And therefore, if you do not have the concept of a group, then you may have to look at structures that look at isolating the company that is making losses so that it is set up in the form of a branch. The benefit of having a branch structure is that those losses can be offset against the UK profits as they arise, rather than being offset against future profits derived from that branch. So again, it is very, very important to see what your business plan indicates. If it's a profit, how do you mitigate the liability on the profits? If you're looking at losses, what is the best form of relief? Do you want to accelerate the relief for the losses, or do you want to defer the relief for the losses when you start making profits in the future? Right, I think I've done my bit. Any questions? Any questions? No questions?